Let's get to it.
I fight to strive. One day I'll have what I want in life.
Hello and welcome to yet another stock review. This time it's on National Grid. Make sure you stick around to the end where I tell you exactly what I've just done with this company. And without further ado, let's get into it. Okay, so first we'll take a look at the company and what it does. Then we'll go on to Simply Wall Street for the analysis. Then from there it'll be on to Trading 212 to look at the fundamentals and key ratios, and finally the conclusion. All of this will be timestamped down below so you can skip to whatever part you need. Okay, so National Grid in essence is a very simple company. Their main goal is to deliver energy to homes in UK and some in the US. We deliver electricity and gas safely, reliably and efficiently to the customers and communities we serve. And their secondary objective is to work towards a cleaner energy. So this is where the things like the alternative gas arrangements come in, and they are now trying to push for that. But other than that, there's not much to say about National Grid. It pretty much does what it says. It delivers electricity to homes using the National Grid. Now that is a good thing for this company, as it has a huge economic moat. Everyone needs power nowadays. We need more and more of it. Here they give you a reason to invest in National Grid. It says here it's one of the largest publicly listed utilities focused on transmission and distribution of electricity and gas. Now, this part here is a bit of an issue for me. They say we aim to be a low risk business that generates shareholder value through dividends and asset growth. Now, the dividends part, yes, they do have, we'll look at all this later, but they do have a few issues that I'm concerned with personally. So if we go on to Simply Wall Street, we can have a look at those issues now. Okay, so down on Simply Wall Street, National Grid is here. Ticker symbol NG. Nice and easy one to remember that. Now it has some things it notes here. As a risk analysis, debt is not well covered by operating cash flow. Dividend of 4.6% is not well covered by earnings. And shareholders have been diluted. Now they're not very good things at all. So we'll go to valuation section. So from a valuation standpoint, it's okay. The fair value is calculated at £13.42, whereas the current value is £10.74, so it is undervalued, not significantly, but it is. Coming down to price to earnings ratio, you can see that the company is at 25.7x, whereas the industry is at 12.7. So the industry is better than the company in this case, and the growth is poor. Book value, again, is sort of in line with the industry, not really much, so that is good there. This has obviously got an X because it's a little lower, but that's not really a problem. Future growth, no, it's kind of be a bit flat. There's going to be a decline in free cash flow there. I could only imagine that dip they're predicting will be to pay off things like debt, and then its forecasts go back up and then down again. You can see the analyst future growth forecasts. You can see the forecasted annual earnings growth and the forecasted annual revenue growth. So the company is looking to do better than the industry in both cases, which is comforting to see that. The return on equity in the future is going to be low. In 3 years, the industry and the company are going to be both low. Past performance, we can see a minus 10.8%, which is obviously not good. You don't really want to be having minuses at all. Doesn't make much sense. And here's the earnings and revenue history graph for you to look at. So as high quality earnings, current net profit margins are higher than last year by 0.1%. Not really the best there. Past earnings, we can see the company was down, and it was only in the last 1 year it's been okay, but still less than the industry there. Return on equity, again in the bad zone, not the best. Return on assets, return on capital employed, both not very good. Financial health, it's the balance sheet and the debt that really lets this company down really. Short-term assets can't outweigh the short-term liabilities, definitely not the long-term liabilities. The long-term assets can outweigh the long-term liabilities, but not. This is the one you need to focus on for sort of raising quick cash and sorting debt out quicker. And here you see the problem of this company. So I've turned on cash and equivalents, but you can see it just has a debt problem and it's only increased now. it's just really not good at managing its debt, to be honest. They have reduced this debt over the past 5 years, but it's still really high. The debt coverage is not well covered by operating cash flow. It can pay its interest coverage, but that's neither here nor there when it can't cover it in operating cash flow. Coming down to the dividends section, this company does pay a very nice dividend of 4.6%. However, you'll see there's a problem anyway. You go to stability and growth of payments. You can see the dividend per share was going up quite steadily. There was a drop there. If I turn fan per share a second so I can see this better. There was a drop there, and then it went back up. So obviously that drop is not a good sign to see. You want to have consistent growth. Not too much problem, there's only one drop, but this is where it's really a problem. This power ratio. And couple this with what I'll show you later, it's double bad. It's just literally using all this money to pay out dividends, which is no good. Even this in the future is still a high payout ratio. I don't think they'll be able to carry on like this, to be honest. You can see the insider trading. Someone did buy 228 shares, and that was approximately 2.2 thousand. So it seems like a lot of shares, but because this company is like cheap to buy, £10, you can buy a lot up. So this is not even a huge number to be concerned about. This is how it's broken down. So you can see institutions hold a lot of this company, with the general public owning 23% of the company, and then the rest is broken down like this. And you can see here that shareholders have been diluted in the past year, with total shares outstanding growing by 2.7%. So another little negative there. Now we'll head over to Trading 212 because I really want to show you some of the metrics there so you can understand the problem. Okay, so a great thing with Simply Wall Street is you get these recent news and updates. Now, one of these down here is this one. If you click on it, it'll take you to this page. Now, this outlines the debt problem, and people have analysed it and sort of to tell you why it's bad. And the forecast for National Grid isn't good if you read this. So you can literally go on Simply Wall Street. It's a free version I'm on, so you can just click on this and read this in your own time if you want to learn more. But this was a big negative towards the company when I was reading this. You can come down from this section, you'll see shareholder returns. You can turn this on, include dividend returns, and then again we go 1 year 29%, 3 years 53.1%, and 5 years of 51.8%. The industry beat it in 5 years, underperformed it in the 3 years, and underperformed it a year. So in recent times it has been doing a bit better, and you can see the volatility here. Okay, so now we're on Trading 212 and we are on National Grid. So this is the chart. I've put it on max view so you can see back all the way to about 2012 on this graph. So you can see you had a run up, big drop off, and then sort of traded sideways and a nice spike now. So that's how the graph is looking. Coming down here we can see the market cap, PE ratios, revenues, dividend yield, and all that. Here we can see sort of where the company's heading, the financial summary. So when you look at this and other things, it does look promising. Revenue increased 14%. Net income before extraordinary items decreased 24%. Electrical transmission segment increase of 43%, and an increase of 36% there, an increase of 4% there, and an increase of 45% there. So there is increases happening there. Now if we're looking at all ratios, this is where some of the things go a bit wrong. So go per share data, scroll down, and we can see cash. And free cash flow per share, trading 12 months, is a negative number. Now this is a big problem. It's in debt, it's still paying a dividend, and it has negative cash flow. Does this seem like a recipe for success to you? Trading 12 months, dividend per share of 50p. So in my opinion, this company would need to reduce its dividend, get some more free cash flow, pay off the debt, and they'd be in a stronger position. But obviously there's a lot of problems going on with that. management effectiveness, the return on assets, return on equity and return on investments have all been low, to be honest, in 5 years average. The return on equity is the highest of 8.7% basically, but they've all been pretty low. Financial strength, again, got free cash flow trailing 12 months of minus 902 million, so obviously not good, and that's that stupid payout ratio. When it comes to its dividend growth rate over the past 3 years as well, it's been 3%, so that's not the highest amount either. So it's got a decent dividend of 4.whatever%, but the dividend growth, again with the debt and all them issues, personally for me is just a bit much. We can have a look at the income statements. Now the income statement's got total revenue, total operating expenses. So from 2019 we had total revenue of 14.93 billion. This then decreased to 14.54 billion, and then we had a nice increase in 2021. Total operating expenses in 2019 were 12.06 billion, then 11.76 billion, and then 11.88 billion. Net income, if we scroll down a bit, put it there, go to 2019, 1.51 billion, then we had 1.26 billion, and then we're at 1.64 billion there. So in the last year it's done a bit better, but again the previous weren't the best. We can have a look at the balance sheet, total current assets, total liabilities, and there we go. If we just do this, it'll be easy to see. 2019, so you've got total current assets of 7.95 billion, and then you had total current liabilities of 9.13 billion, so not good. Total assets did outweigh the total liabilities, and then in 2020, total current assets of 5.8, total current liabilities of 8.56, and total assets did outweigh total liabilities. And then total current assets now are actually beating the total current liabilities, or in 2021 they are actually beating the total liabilities there, and the total assets are beating the total liabilities there. So in 2021 things are looking better. If we go into cash flow and scroll to the bottom, net change in cash, we can see in 2019 they had minus 77 million, 2020 they had minus 179 million, 2021 they actually do have a plus of 84 million. So in 2021 they seem to have a good time. Okay, that is it for the analysis. Now to conclude, this company, and you've probably picked up on this in my opinion, is not in the best place right now. The debt issue it has is a bit too much for me as an investor to get over. I don't have confidence that if an issue did arise they'd be able to pay off the issue. They have no free cash, their debt is crushing them. I just don't feel like now's the best time. Now saying this, it seems to be going in a better direction the past year. The numbers are looking better with this greener energy coming into play now, and the sort of industry it's in. We'll always need power. They own a hell of a lot of it. In the UK you talk about the national grid, it's like that is what it is, it provides the power. It's hard to think of something else taking that place, so that's where it has that economic moat. Okay, so at the start I told you to wait to the end to see what I did. Now I'll show you that now. If you scroll to the bottom on Trading 212 you get to a section called History. Now if we press this you can see that I've recently sold. I literally did it today. So you can see down here that I made a profit. It says £46.77, but then you need to add on the dividends here. So obviously it's not the craziest amount, I didn't invest a crazy amount to start with. I was lucky and bought in this dip down here, and this is the time that I saw bought in. So obviously I rid this nice wave back up, and I was thinking now is the good time to sell. Its highest peak it had was up here. It's sort of close to that range now, it's going up that direction. I don't think this will sort of go much higher than this. Like I said, I really like the economic moat this company has, the industry it's in. This UK relies on the national grid basically, but when looking at the fundamentals and the profit I had, I thought now was a good time for me to sell that. and put it into some other better companies in my opinion. So I hope you enjoyed and got some value out of this video. If you did, like, comment, subscribe, all that good stuff. Check out all the links in the description. Sorry I've been away a bit. I have had a new thing come into my life which is taking all of my time now. It's a large responsibility to deal with, so videos might be a bit sort of less quality, and it is sad to say that because I do want to go like full force in YouTube. That was my plan, it still is. I just need to get through these few weeks with this new commitment, and then I'll be full on again, going back to it, making better videos. And I'll catch you in a bit. Peace out.
Tell me pretty lies, look me in the face, tell me that you love me, even if it's fake.